Now let's look at for the puts. For puts, it's just the reverse as we said. So 14,800 strike price. So your 14,800 minus the current market price of 14,485. What is your incentive value here? 315 rupees. So the premium was 330. So 315 plus 15 rupees of the time value, that's your 330 rupees. Right? So this was your in the money for the put. So similarly, if you look at the money, see there is no, conceptually there is nothing called at the money. Okay, though we write it at the money in theories, but practically there is only in the money and out of the money. So if you look at the money, it is the first strike price of in the money. So the premium was 135 rupees. So 14,500 was the strike price. 14,500 minus 14,485. So you have 15 rupees of actual incentive value here, and 120 rupees, which is 135 minus 15. 120 rupees is your time value. So sometimes you wonder, like we have bought this last week, this put of 14,500. The market remained where it was. In 2 days' time, it just became 15 rupees from 135. How is that possible? It's possible because of this, the time theta decay or time decay. So 14,300, it is out of the money. So as we shared, in out of the money, your premium cannot, incentive value cannot be negative. So your incentive value is always zero. So anything which is there out of the money is 65 rupees, which was the premium that point of time, is your 100% time value. So you have two values here, incentric value. One is incentric value, the other one is the time value. So a buyer, when he pays a premium, he pays these two. So a seller, when he's buying when he's selling an option, he earns these two. So a seller of a put at 14,500 has a guarantee that if the price does not move down or up and stays where it is, he will still get this 120 rupees in his pocket. In this case, he will earn the full thing. So seller bets on earning this part. A buyer bets on earning this part. He's expecting the price to increase so that the incentric value will move up. So that's what we saw, just the reverse. So at expiry in options, all options at expiry, they trade with their incentric value. So they trade with their market price of the underlying minus the strike price, or minus the strike price. That's the difference they trade at. Because with the passage of time, your time value keeps on decaying. So initially, if you're trading on quarterly ones, the time decay will be very slow. As and when it comes closer to the expiry, it reduces drastically, it falls very fast.